It was a time of greed and unwise decisions. The stock market skyrocketed only to fall, destroying hundreds of businesses and losing trillions. This is the dot-com bubble in HD. In 1975, the first personal computers were created and sold on the market. Along with this, they included Windows 75, which would be the first software used to browse the internet by millions of Americans. By 1980, the personal computer had become a common household object, which meant one thing: millions of Americans had access to the internet. Nowadays, it's hard to imagine a world without our favorite sites such as eBay and Facebook, but at this point in time, the internet was virtually untouched by the market. Of course, that's partly what made these e-companies so attractive. This made it a golden opportunity for companies. It truly was the next great step for the worldwide market.
Now that I've gotten on the internet, I'd rather be on my computer than doing just about anything.
It was at this time that some of today's most prosperous companies were formed. Amazon was established July of 1995, one of the first of its kind. eBay was founded September of the next year. It truly was the beginning of an entirely new era of trading. Initially, these e-companies weren't valued very highly. They were the first of their kind, making them risky to invest into. It didn't catch on until the late 90s. Amazon went public in 1997, starting with $18 a share, and by 2000 was valued at $100 per share. Priceline.com began trading stock on March 1999, and in their first day of trading jumped from $18 per share to an impressive $86 per share. But these weren't isolated cases. This was happening to hundreds of e-companies all at the same time. In the late 90s, investors had realized how much potential there was in these companies based on the success of eBay and Amazon. They rushed to invest into e-companies, hoping to be part of the next big thing. Adding to this surge of rapid investments, the Taxpayer Relief Act was passed on May 7, 1997. This act lowered the tax rate of invested money from 28% to 20%, making investing seem like an even better idea. It was this frantic dash to invest into e-commerce which caused the bubble and ultimately popped it. This opportunity seemed to hold so much promise that investors threw the most basic principles of investing out the window. Investors gave incredible amounts of money to companies they didn't have adequate knowledge of. Some didn't even offer a product, and most had little to no revenue. This was unwise investing at its worst. On March 10th, 2000, NASDAQ reached an awesome height of 5,048.62 points. This was the turning point in value of e-commerce stock. At the time, NASDAQ, home of many tech and e-companies, was valued at a mind-blowing $6.71 trillion. However, the bubble popped, and by April 6th was valued at $5.78 trillion. NASDAQ had experienced a nearly $1 trillion loss in less than a month. In the end, a massive $5 trillion loss was credited to the dot-com bubble, killing hundreds of companies and losing thousands of jobs. At the time of the bubble burst, 1999 through 2001, stock for e-companies was greatly overvalued, especially since these companies typically had little to no revenue. Despite this, it appeared the companies were making profits due to the continuous increase in stock value. Why sell your stock when it's only increasing in value? And then the bubble popped. Sale records of Christmas 1999 were released in 2000 to the public. The sales were surprisingly low, illustrating just how overpriced the stock was. On top of this, expensive sell orders by tech companies were processed on March 10th, inciting panic among investors. This deadly combination caused a mad dash to sell stock in e-companies and effectively popping the bubble and losing $5 trillion.
Sonny, there's only one word to describe what's happening, and that is panic.
Although the dot-com bubble was an overall failure, some of today's top online companies rose from the ashes. Amazon.com was one of the first e-companies who ended up successful. Because Amazon was established ahead of its time, the company had time to get itself off the ground and running while other companies were still in the startup stages. In fact, the company originally named Cadabra was first housed in Jeff Bezos' the company's founder's garage with tables they had made themselves. In short, a humble beginning. Eventually, the company established headquarters in Seattle, Washington. Also imperative to Amazon's success was the strategy Jeff Bezos took. Most of the e-companies at the time weren't thinking of long-term success. A common strategy was using aggressive advertisement campaigns to try and corner the market and raise company awareness.
You said you had a large selection of invitations.
What we do.
Then why does she have my invitation?
What may be a little thing to some
You are mine, little man.
could be a really big deal to you.
Is that your wife? Not for another 15 minutes.
After all, it's your special day. OurBeginning.com. Life's an event. Announce it to the world.
Any idea what the product was? Even still, this commercial cost millions of dollars to be made and featured in the Super Bowl, along with Pets.com spending $1 million to have their popular sock puppet mascot featured in the Super Bowl as well. They did this even though their annual revenue was only $3 million. It doesn't take a genius to know that spending 1/3 of your yearly revenue on a single commercial is unwise.
I just want you to stay.
Hey man, I'm getting carsick. I think I'm gonna boot.
The successful companies of the dot-com bubble took a much more practical approach to build up their companies. In its early stages, Amazon focused more on building its selection in order to please the customer base instead of advertising. If you're competitor focused, you have to wait until there's a competitor doing something. Being customer focused allows you to be more pioneering. Jeff Bezos. Amazon was focused on long-term profit, so much so that they made it clear Amazon would not generate profit till 4 to 5 years in the future. Today, the company is valued at $292.6 billion. Question is, have we learned from this epic failure that lost so much? Many believe that today another bubble is forming and it is just getting ready to pop. Stock and tech companies have once again reached new heights. In 2015, NASDAQ reached 5,218.85 points, the first time it had reached those heights since the 2000 dot-com bubble. Today's bubble revolves around cloud-based companies such as Snapchat, Uber, and Dropbox. But this bubble could be even more deadly than the one of 2000. Today's bubble largely relies on private investors, and if it does pop, they will take a major hit. Others say that the rumors of today's bubble are false. They believe that the world has learned from the events of 2000 and that today's private investors are in it for the long haul as opposed to back in 2000 when people just wanted to be part of an entirely new market. It's important to learn from the mistakes of the past. The dot-com bubble of the 2000s lost so much for so many. This event is something anyone investing money into stocks should keep in mind. Happy investing.
Take a spin, now you're in with the techno set. You're going surfing on the internet.